Everyone, welcome to a new session of Room for Discussion. As you may have noticed by now, this session will be held in English, contrary to policy. My name is Paul. I'm with Philip, interviewing today Mr. Peter Cornelius. It's my distinct pleasure to introduce the Chief Economist of AlpInvest, Peter Cornelius. AlpInvest is a firm that invests in private equity funds. We will speak with Mr. Cornelius about the universe of companies responsible for, e.g., the backing of Google and the buying out of Burger King. He's the absolute perfect guest, in our opinion, to discuss this subject. Apart from his post in AlpInvest, he still publishes, and his third book is forthcoming, Managing Illiquidity. Perhaps some quick background on the private equity business. As the name implies, it is the corollary of public equity. It does investments generally not available to the public. Following the broader definition of private equity, it includes buyouts, where large companies are taken private, generally financed with a large portion of debt. Venture capital, investing in young growth firms. Mezzanine finance, basically the layer of financing between senior debt and equity, and distressed assets. We will speak to Mr. Cornelius today about his role and his view in this challenging industry. Should you have any questions to Mr. Cornelius, please do not hesitate to ask them. The public microphone is available to this end. Please help me give a very warm welcome to Mr. Cornelius.
Mr. Cornelius, welcome at Room for Discussion. Just as Paul said, you had several very prominent positions as an economist. For example, the senior economist at the International Monetary Fund, the chief economist at Shell, and now you are chief economist at AlpInvest. Could you explain us what is a chief economist?
I guess that's a very interesting question. So you mentioned, or you did not mention one position which I think was also an important one, which was at Deutsche Bank. So I was sitting on the trading floor working with traders, and in particular in the foreign exchange markets, the investment horizon, the long-term investment horizon is 3 months. But typically traders are interested in the next week or maybe the next 4 weeks. So I did this for 2.5, 3 years, but I did not find this particularly rewarding from the standpoint of an economist. Essentially, what this work entails as an economist sitting on the trading floor of a large investment bank is to predict the next central bank move. So I think it's very interesting for a limited period of time, but after 2.5, 3 years, I thought I had enough. Let alone to get up at 5 o'clock in the morning to have early morning meetings at 6. But then at Shell, the position I had just before joining AlpInvest, you take a very long-term view, up to 50 years. So Shell is, of course, famous for producing oil and gas, but is also famous for doing long-term scenarios. So scenario planning in Shell was introduced in the 1970s and has become an integral part of the strategic investment planning process in Shell. Now, many of you might know some of the projects Shell has invested in, including Sakhalin-2, which was in the news a couple of years ago again. That's a $20 billion investment with a lead time of about 18 years. The contract with the Russian government was signed in 1990, and the first oil and gas was produced 2 or 3 years ago. So a long lead time, which means also a very long planning period. I think this is extremely interesting from a professional standpoint to be involved in a scenario team that includes economists, political scientists, physicists, and so on. But the outcome of your work is way beyond your pension age. Whether or not we did a good job with the scenarios we produced in 2003 to 2005, I don't know. We will know by the year 2050. So in private equity, it falls somewhere in between. You take investment, or you plan your investments with a view over the next 5 to 10 years. And I think that's an extremely interesting sort of proposition from a professional standpoint of an economist.
So as an economist, could I describe this function as somewhat of a bonding agent between political scientists and perhaps a physicist in the case of Shell, and basically trying to determine the influence from these different standpoints?
I think to some degree that's true. So what I'm doing in AlpInvest is to work on the asset allocation. So I work very closely with clients. Here in the Netherlands, as you might know, APG and PGGM are some of our core clients. In the US, we have a number of pension funds. So I'm working with them closely on their asset allocation. So how much should they allocate to private equity relative to other asset classes? That includes increasingly the question as to how much capital should be invested in emerging economies. Whenever we talk about emerging economies, I think there's always a significant political component involved.
Yeah, we will get back to this point in private equity in emerging markets. So let us look a little bit closer at AlpInvest. I think it was raised by APG and PGGM as some. Could you tell us a little more about the inception of the firm itself?
We have to go back about 15 years in history. APG and PGM are some of the largest pension funds worldwide, and they decided in the late 1990s to join forces and to create a separate entity, which is AlpInvest, essentially a captive private equity investment firm. Until very recently, we managed exclusively the private equity portfolio of these two pension funds. I guess there are different reasons why the two institutions decided to outsource private equity. I was not involved, so I can only speculate. But when you look at what is happening right now in the U.S. pension industry, there's a very high turnover. So people are subject to the government pay scale as far as U.S. public pension funds are concerned.
So now Carlyle has acquired AlpInvest from the two. Could you tell us a little bit about the structure because Carlyle itself does private equity investments as well in a GP form. Could you tell us about that?
Yeah, so what we are doing, we're doing three things essentially. We do investments in private equity funds, with the notable exception of Carlyle. We are not investing in any Carlyle fund. There's a clear Chinese wall between the two institutions. We are doing direct co-investments, which are a form of direct investments in companies alongside private equity funds. Again, no deals with Carlyle. And we do business in the secondary market. We purchase private equity portfolios from other limited partners. What we do is totally separate from Carlyle. However, when Carlyle go to their clients, they say, we have also the possibility to help you allocate resources to different funds we, as Carlyle, do not offer. So the products they can offer to their clients has become significantly broader. for example, through secondaries, for example, through co-investments with other funds.
So AlpInvest mainly acts as a limited partner. Could you maybe, these are one of the major terms in the private equity industry, you have the general partner versus the limited partner. Could you explain the difference to the students and how do they relate to each other?
So essentially it's a legal construct, a limited partnership which is well known in the UK and in the United States. The general partner runs a fund raising capital from investors. A typical investor are pension funds, insurance companies, family offices, university endowments. I don't know whether the University of Amsterdam has an endowment, but some have very significant amounts of capital they manage. Harvard, more than 25 billion. Yale University, about 20 billion, and they invest significant amounts in private equity. And then finally, and more recently, sovereign wealth funds. So these are the long-term investors who provide the capital which is managed by the general partner, essentially a fund manager. So Carlyle, as we already mentioned, other big general partners are KKR, Blackstone, TPG, firms that manage between 50 and 100, sometimes even more billion of US dollars.
What do you think of sovereign funds investing in private equity?
Well, I think they're uniquely positioned. Private equity is an industry with a very long-term view, 5 to 10 years, sometimes longer. So you need to have the liquidity profile in place that allows you to lock away capital for a very prolonged period of time, which is very different from investing in public equity. Today you invest in the Dutch stock market, and tomorrow, literally tomorrow, you decide that that was not a good investment and you want to get your money back. Well, then you sell your mutual fund, your ETF, what have you. In private equity, once you make a commitment, your capital is locked away for 10 to 12 years. So pension funds are in the position to do this because of their liabilities. Sovereign wealth funds can do this, and family offices can do this, and insurance companies, but only life insurance companies. Non-life insurers are typically not invested in private equity.
From my understanding, though, sovereign wealth funds do not invest in private equity only for the returns, but also to perhaps contribute in their part to with a social component.
Or a political component.
Perhaps a political component.
Well, those claims have been made. It is very difficult to say what really motivates sovereign wealth funds. Those we talk to as investors in our fund, I can assure you that they look very closely at the returns they get from private equity.
Fair enough.
And other asset classes. There might be some political component involved at the margin, but I think predominantly investment decisions are driven by return expectations.
What you just said is actually that in private equity you cannot just simply exit because of the illiquid nature of the investments. But how does that influence your investment decision, for example, at AlpInvest?
Well, I think I would go even one step back in the sense that how much capital should a limited partner allocate to private equity? Given the illiquid nature of the asset class. So should that be 5% or 6% or 10% or even more? So APG and PGGM have invested 6% of their capital under management in private equity. Kuipers, the largest US pension fund, has 15%. And they got into massive trouble in 2008. There's actually an interesting case study for those of you who are interested in the academic research aspect of this case. So you make a commitment to a private equity fund, but you don't know when the general partner draws down the capital. So to be very concrete, we make a commitment to a KKR fund. Mm-hmm. And then KKR decides to acquire an asset, let's be very specific, Alliance Boots, a pharmacy chain in the United Kingdom, one of the largest deals in European history. Mm. We do not know when the general partner, in this case KKR, comes to us and says, given your commitment to our fund, we need from you 100 million euros. And you have about 7 days to come up with that capital. You don't know the timing, nor do you know the amount. And the same is true on the exit side. We as a limited partner cannot intervene in this process. The general partner, the fund manager, is entirely responsible for the investment process.
But you cannot exert any kind of influence?
Absolutely not.
And why not?
So let's go back to the Kuipers case. In the financial crisis, the distributions, that is the exits of companies, completely dried up, but they continued to buy companies. So they called literally the limited partners and said, we need money from you. At exactly the same time, the hedge funds they had invested in came up with margin calls. And all of a sudden, there was a liquidity squeeze for Kuipers, a pension fund managing 270 billion US dollars. So what are the options? Option one is you sell in the secondary market at fire sale prices. Inevitably, you make huge losses. Mm. Or you default, which is very serious. If you make a commitment and you don't come up with the capital, it's a default, legally speaking, and you are out of the private equity market. Or you sell other, more liquid assets. Now let me ask you, what do you believe Kuipers did?
I would wager they'd sell their more liquid assets.
Exactly, and what was the most liquid asset at that time?
Stocks and bonds, I would say.
Which stock in particular?
Which stock in particular? I couldn't answer that question.
It was Apple.
Apple.
Okay.
They sold almost their entire Apple portfolio. Missing the huge recovery in public equity prices after the Lehman collapse. The case study Columbia did on this particular case comes up with an estimated loss of 70 billion US dollars, which were not recovered. So you better make sure that you get the liquidity management right if you invest in very illiquid asset classes. And private equity is just one example. APG, PGGM, and other pension funds also have illiquid assets in infrastructure and real estate. So we're not talking about 6% exposure to illiquids. We're talking more like 15 to 20%. Now there is a big, since we are here at the university, there's one big gap in financial research. Those of you who take classes in financial economics will be familiar with the CAPM model, capital asset pricing. This dates back to the 1960s, essentially. Those models have been created for marketable instruments, public equity and bonds. They have not been created for illiquid asset classes. And that is one of the most fundamental challenges in the industry from a practitioner standpoint. And I think it's becoming one of the most significant challenges in academic research. We've just seen the first few papers on this particular aspect triggered by the experience a lot of limited partners made in the financial crisis.
So
Well, I've found my thesis subject now. Thank you. Let's maybe look at the more macroeconomic scene, because if we zoom out, what is the state of private equity presently?
Well, I think there is some disillusionment, if you like,
Disillusionment?
in the sense that I think a lot of limited partners have found that their return expectations have not always been met. And there is a significant gap in private equity returns from a gross and a net perspective. So general partners get compensated essentially in two major ways. They charge the limited partners management fees for managing a fund, which is typically 1.5% to 2% per annum. And then there is what we call in the industry carried interest. And carried interest is 20%. Typically, there are funds that charge even more.
that's performance-based.
That's performance-based and typically subject to a hurdle of 7 to 8%.
So once they make 7 to 8%, they can start charging these incentive fees.
Exactly, exactly. So from a limited perspective, a limited partner's perspective, what counts is, of course, the returns net of fees.
Mm-hmm.
And what we have found in the industry, what limited partners have found, is that returns, if you are in the average fund, will not compensate you for the risk you take given the illiquidity of the asset class. You get returns that are similar to public equity, but why would I invest in private equity taking the illiquidity if I do not expect higher returns?
Yeah, exactly. That was also the critique of Ludovic Philippou, who's also a lecturer here at the University of Amsterdam. Well, yeah, the returns are on average more attractive in public equity. So, is public equity not maybe better than to invest in contrast to?
I think it depends.
Private
It depends very much on whether you are in the average fund or whether you are able to identify the outperformers. So we employ 72 investment professionals right now in 3 offices in Amsterdam, in New York, and in Hong Kong.
Mm-hmm.
And we screen about 800 funds per year. Not too many investors have the capacity to do this. But I think I would agree with your statement that if you are in the average fund, private equity does not look particularly attractive. So I think an extreme example is venture capital. We all know about the Microsofts, the Apples, the eBays, more recently Google and Facebook. So AlpInvest has invested in a fund that has invested in Facebook as one of the earliest investors.
And which one was that?
Excel Partners.
Okay.
Excel Partners belongs to what we call the Golden Circle in Silicon Valley. There are 6 firms that have backed all these companies I just mentioned. The Googles, the eBays, the Microsofts, the Apples.
So you have to have the relationships in place to even invest in a Golden Circle fund.
So the Facebook deal made 800 times our invested capital, 800 times. Now this sounds extreme, and it is. As a large investor, if you are lucky enough to get into those funds, your allocation is extremely limited. You cannot say, I like this particular fund, and as a large pension fund, I invest 50 million in Excel partners. It's not going to work that way. If you're lucky, you can invest a handful of millions. And the question for a large pension fund like APG comes up, well, that doesn't really move our needle. Why should we invest in venture capital if we can put at work an amount of maybe 2 or 3 million? So typically in venture capital funds of this capacity, you find in particular in university endowments and family offices that typically manage smaller portfolios.
So university endowments, now that you mention them, generally there's the returns that limited partners make are quite heterogeneous, also from their profile. So from what we've seen, university endowments vastly outperform, for instance, banks. So is this? Could you explain this? Does this lie in this same extent?
Yeah. So banks tend to cross-sell their products. So they invest in buyout funds. And you mentioned venture capital funds, distressed buyouts. Buyouts are by far the most important subsegment of private equity. So,
could you maybe explain what buyouts exactly are?
So essentially, private equity provides capital for companies throughout their life cycle, from very early stage where companies have no revenues and earnings.
That's the venture capital?
That's venture capital. And in venture capital, you can differentiate between seed capital or even angel financing to late-stage venture capital. And you have growth capital, where companies need capital to continue to grow, but they already have earnings. Next stage is buyouts. These are companies that are fairly mature, but requires restructuring. And then you have distressed turnaround situations where companies require capital to be restructured in a situation where they are distressed.
Financially and not economically, I would presume.
Well, one can differentiate between economic distress and financial distress. So in most cases, we're talking about financial distress where a company is over-indebted. So you need to reduce the amount of debt on the balance sheet of a company. But coming back to the buyout case, so from a bank's perspective, it makes a lot of sense to support a particular fund. And then the fund comes to you as an investment bank and says, oh, by the way, can you help us do the M&A transactions for the deals we're doing? So from a bank's perspective, they see the returns from a holistic balance sheet standpoint, not necessarily from the standpoint of the private equity portfolio only. For family offices, the situation is fundamentally different. Essentially, they're driven by the objective to preserve the capital of the family. They take very long-term bets, and they have very substantial allocations to private equity, in some cases up to 50%. They're not interested in going in and out of financial markets. They make very long-term commitments. And the same is true to a significant degree, at least for university endowments.
And you mentioned restructuring. Because what I find very interesting is that private equity is not only it's not only about the numbers, because when you buy out a company, you also kind of get attached to the management. You also have to manage the management. How does that work? How the personal aspect of that?
Well, as a limited partner, we are sitting in some cases on the board of companies, but only to the extent that we are a co-investor. Otherwise, this is entirely up to the general partner. So the fund manager acquires an asset, And I think here the important difference between public and private equity is that in most cases you acquire the majority of the capital of a company because of the principal agent problem you have in public equity. So essentially you do two things. You work with the incumbent management, but you incentivize the incumbent management differently through stock options in particular. So there's a lot of upside for people who are running private equity owned companies. But at the same time, there's an important carrot in the sense that buyouts are typically leveraged buyouts. So 2/3 of the capital is typically bought. And in order to meet the debt obligations, you need to perform. So there's also a significant downside for the management of a private equity-owned company. So from a corporate governance standpoint, I think there's a fundamental difference between a publicly owned company and a privately owned company.
So the leverage contributes in more ways than just a tax shield or to amplify returns, but also in incentive management?
Absolutely. I think it's a mystery, and again, this is a puzzle which has not yet been solved by academics, nor by practitioners. Why is it that the S&P 500 companies in the US are much less leveraged than private equity? There is a significant tax advantage. Essentially, everything we can learn from private equity could be used in public companies as well, but it isn't.
Why not?
Well, that's a question a lot of people have asked, but I don't think that anyone has given a very convincing answer. So coming back to leverage and debt, I think it serves a number of purposes. One is the tax aspect, but it is also a significant stick for managers to perform.
So we here at the faculty learn about Michael Jensen, who I believe was at Harvard when you were as well, and he published a paper which probably everyone here has read or will read at some point, The Eclipse of the Public Corporation. Basically what he argues here is that for mature declining industries, the public shareholder model is essentially dead. So would you agree with this critique?
Well, the paper was published in the Harvard Business Review, I believe, in 1988. And I guess this happens to many people. They get carried away by the currents of that time. Let's go back to the mid-1980s. In the early 1980s, Michael Milken created what is called the junk bond market, which essentially allowed buyout firms to acquire very large assets. And so there was a first buyout wave in the 1980s, which culminated in the buyout of RJR Nabisco, still one of the largest deals in history, $28 billion.
RJR Nabisco was a company producing foods and food services, I believe, and
they produced basically everything from biscuits to cigarettes. So Winston, for example, the cigarette brand, I believe it disappeared in the meantime, was part of that business. And since smokers are very addicted to smoking, that's a great cash flow model. So although fewer and fewer people smoke, that's an industry of great interest from a private equity standpoint because the cash flows are very predictable. Right. But coming back to the RJR Nabisco case, that was done in 1987. And it was done with 95% debt and only 5% equity. So a lot of deals were done in the 1980s thanks to the availability of cheap debt. And it is in this context that Michael Jensen did this paper predicting the eclipse of the public corporation. I think the public market is still well into life. I think we now know after 20 years or so that the private equity model has not quite taken over. Although, when you look back what happened between 2005 and 2008, private equity accounted for 35% of the global M&A market, so a very significant contribution. But nevertheless, public equity is, I think, has a future.
So in the tobacco example we previously mentioned, there's large cash flows coming in from smokers being very addicted to their product, but there really isn't a lot of investment opportunities. So in this context, there is some pressure on corporate managers to destroy value instead of basically giving it back to their shareholders. This seems like a perfect entry opportunity for private equity.
Well, right now, I think we are in a situation where it's so much macroeconomic uncertainty that we see very little M&A activity, including those by financial sponsors, general partners. So when you look at valuations in Europe, and the way we look at this is we adjust earnings on a cyclical basis. So what we are looking at are cyclically adjusted earnings or price-earning ratios. And there are, in most markets, very significantly below the historical average. That would imply, other things being equal, that there are very good investment opportunities to be had for general partners. And yet, it doesn't happen. So what a lot of investors seem to have in mind right now are kind of worst-case scenarios, that the euro falls apart. If it does, then the historical average of cyclically adjusted private equity ratios becomes, of course, meaningless. But it seems to me that a lot of investors have become kind of paralyzed. And when you look back at who made the best returns in private equity, these are those who took advantage of financial turmoil, situations where a lot of other people decided to stay on the sidelines because of a high degree of risk aversion. With hindsight, the best returns were made in situations with substantial financial dislocations. And I guess this time around it will not be different.
And what are at this moment, what are the major threats and opportunities in private equity?
Well, some general partners take a very close view at the European situation, including Carlyle. Blackstone has just opened an office in Spain. Essentially, you take a bet on the future of the euro. Right?
What is AlpInvest's strategy right now?
I think we are in the camp of looking very closely at the investment opportunities that lend themselves in the current macroeconomic environment. Of course, it's very easy to say, this is so much risk I don't want to take. But then essentially what is happening that you park your capital in US treasuries with significant negative real returns. So general partners worldwide are sitting on more than 700 billion US dollars in what we call dry powder, commitments made to funds, capital that's that is waiting for being invested. So there is no shortage of equity capital to be invested, nor is there any shortage of debt capital. It is more like identifying the investment opportunities in the current environment.
What is the worst thing that could happen now for private equity in the current macroeconomic situation?
Well, I mean, apart from the overall macroeconomic situation, which could do a lot of damage, I think under more reasonable base case scenarios we contemplate, at least, I think the biggest risk is not to invest. You know, when we talk about investing, whatever asset class it might be, we talk about risk management and risk measurement. Investing and risk management go together. And it depends very much on your risk appetite and your risk assessment. So I think the biggest risk right now for me is that we get so paralyzed that we ignore the investment opportunities that arise in the current environment.
Because that is a point of critique, right? That the 700 billion you mentioned in white powder, that GPs are still charging management fees even on these funds that are basically sitting out of the market.
Yeah, it's very annoying. I totally agree.
So do you pressure this model of fee structure?
Yeah. Before I come to that part, it is equally or even more annoying that the holding period of assets get more and more extended because of the situation in the exit markets. The IPO market is very inactive right now. So some general partners, I don't want to generalize, but some general partners are holding on to underperforming assets. There's no way that these assets will make the hurdle of 7%. But as long as the general partners keep on or hold on to the asset, they get management fees. So it's a disincentive for them to sell. So we pay management fees on dry powder, and we pay management fees for companies that are not exited, but where we see very little, if any, possibility to make the 7% hurdle. So that's quite annoying.
And if we take private equity on a more global scale, how would you identify the differences between private equity activities in different continents? For example, why is it that the private equity market is much bigger in the US than in Europe?
Well, it depends on what kind of market we talk about in Europe. When you look at the UK, I think the size of the UK market relative to the size of the economy is very comparable with the United States. The US is basically the cradle of private equity. And venture capital was first, then buyouts. It had to do with an important decision the US government took in the late 1970s. Before 1979, pension funds were not allowed to invest in risky assets, including private equity. Since 1979, they can. It's a prudent men clause. So there's a longer history. In the European private equity market, I think we are catching up in some markets, not in all. In continental Europe, one of the most deeply penetrated markets is actually the Netherlands. And I'm sure you have seen a number of deals made here in this country.
So if we look at Asia, it's quite rare to acquire a majority stake in Asia overall. So how does this work? Because you're essentially committing to the corporate governance that is within the company. You can really make changes from within. Could you elaborate on that and the risk it entails?
I think it's a very good point. So to a large extent in Asia, we have a situation where companies do not need buyout capital, but they need growth capital. So they cannot easily go to their banks and say, we want to grow and we need liquidity. So this is a situation where private equity comes in. But the owners of the company don't want to give away their majority ownership. So a typical investment is between 5% and, say, 20%. And I think it raises a number of important issues private equity historically has addressed very well. So here in Asia we have a new situation, and it's too early to tell what the outcome is going to be. We know from the experience in Central and Eastern Europe that it does create problems. So what happens, for example, if a private equity fund with a limited lifespan of 10 years says, we have been holding to our asset for 5 years, it's time to exit. And the owner of the company, typically the founder of the company, says, no, I have no interest in exiting my company now. Why should I sell their fantastic prospects for the firm? And this creates tensions between the majority and the minority shareholders. And we have seen this in a number of cases in Central and Eastern Europe. And I wouldn't be surprised if we would be seeing this in Asia or in other emerging markets as well.
Could you perhaps help us with an example? So where perhaps a GP was about to exit or wanted to exit, it was basically barred off.
Well, in many cases, well, first of all, you want to manage that particular risk through a shareholder agreement between the majority and the minority shareholders. But of course, in many emerging markets, there is a gap between the law on the books and the law that is actually being implemented. So now you have a shareholder agreement, and then when the push comes to shove, the general partner says, it's time for me to exit this asset. Then you can sue the majority shareholder. But you need a predictable law system in order to do that. The way I would define an emerging economy is that the institutions are still emerging, including the legal institutions. This is how I would see an emerging economy. So the law is not always predictable. I can write very good shareholder agreements, but what if the law is not sophisticated enough and predictable enough to make this really worthwhile as a risk management tool?
And besides the law, how do you cope with political risk in emerging markets?
First of all, I think I should say that private equity investments in emerging markets are heavily concentrated in just a handful of cases. Just a handful of cases. It's China, it's India, it's Brazil, so the BRICS, much less Russia, by the way, much less. Russia has attracted very little private equity capital.
And why is that?
Because of the fact that you just mentioned, country risk, right? Political risk. So you have all kinds of different risk components which would fall under the rubric of country risk, and we monitor each of these components very carefully when we make investments in emerging economies. Accounting risk is another one. So from a general partner's perspective, but also from a co-investment perspective, you want to know whether there is actually an asset or whether this is just an empty shell. So what we do routinely in emerging markets is to hire companies like Kroll International to do background checks on all the managers. Is there actually a company we acquire, or is it just a company that exists on paper?
All right. I think we have 5 minutes, so that we perhaps should work towards a conclusion. We've talked about private equity and the challenges, and basically the challenge of GPs sitting out of the market, having trouble exiting investments. We have seen very prominent private equity funds actually changing their names to alternative investment managers or these types of classifications. We have even seen private investments in public equity or PIPEs. Would you say that the business model is becoming somewhat convoluted?
Well, I think there are two trends we have been seeing over the past 5 years. The first one is, and which is a kind of misnomer, a number of private equity firms have gone public. So Carlyle is actually a publicly listed firm on the New York Stock Exchange. So is Blackstone, and so is KKR. So I think what is important, though, is that it's really the management company and not the funds themselves that are publicly listed. The second trend we are seeing is that those private equity firms are transforming themselves into alternative asset managers. So Carlyle has acquired AlpInvest. 60% of the firm is owned by Carlyle. So they have a secondary business now, a fund-of-fund business, a co-investment business. But they have also acquired 2 hedge fund managers. They are in the credit business. They are in infrastructure, and they are in real estate. And we have seen some interesting examples. So Texas Teachers, a big U.S. pension fund, has given $3 billion each to KKR and Apollo, another big name in the industry, and said, we don't have the capacity to do our allocation within alternative assets. We give you $3 billion, and you decide whether you want to invest in private equity, in infrastructure, in real estate. So essentially, they are outsourcing the asset allocation for their alternative investment portfolio to fund managers. And those firms I just mentioned have seen this as a new business model. Private equity has become too narrow. A lot of large pension funds have assets also in other alternatives. So they provide a solution for the entire portfolio of alternatives. The exact opposite is what the Canadian pension funds are doing. They are insourcing. They are competing with general partners by doing large direct investments. And they have hired a large number of people doing what GPs are typically doing, sourcing deals and managing deals and exiting deals. So they are essentially insourcing, whereas other US pension funds are outsourcing, some of them. Looking forward, difficult to predict what the dominant business model is going to be. It depends, I guess, on the risk appetite, on the capacity in individual cases. But these are the trends we are currently seeing in the industry.
Yeah, we are almost at